So Resolution Capital is a dedicated global real estate investment manager. We invest in listed real estate securities located in major markets around the world. We currently manage around about £4.5 billion, or circa 8 billion Australian dollars. We run a concentrated global portfolio. It has around about 45 to 50 stocks typically, which are focused on the major markets, high quality cash flows, great real estate, hard to replicate, and we do it with a long-term goal, a long-term objective. We think about basically it being a place to store wealth that hopefully will grow at least in line with the global inflation rate over the medium to long term. Clearly there's been a myriad of conflicting information out there about economic growth and interest rates and QE and political events, which are creating a very tumultuous period for investors due to the uncertainty of the economic environment, etc. So what we've seen some, moderation in expectations about the future of the economy, the global economy, thanks to obviously trade concerns and the effects of the Brexit uncertainty, etc. And as a consequence, we're going through a period of very changing mood in the market. Some days people are a little more relaxed, but overall there's been an increasing tone of cautiousness. And in that environment, what we're seeing is that people are gravitating towards more secure income streams, more secure returns, and the REITs have generally been able to provide a diversification component within portfolios because of the security of income and the visibility of income. And so what we've seen is basically the REITs have outperformed the equities market over the last 12 months or so. But again, it's very patchy, and as a consequence, the predictability in the short term is very challenging. And that's why the investors are better off sticking with the medium to long term thinking, but expect in the short term some volatility. Well, as people who've followed us for a long time would know, we really are reluctant to give short-term forecasts, and the last 12 months is exactly why we've had that reticence over a long period of time, because short-term events are very unpredictable. So what we look to is the medium to long term. We think there's more predictability in terms of the return profile, and what we're seeing is a market that is in pretty good shape for the long term. So if you look at the REITs, their balance sheets are in fantastic shape. I mean, I've been covering the sector for 25 years, and honestly, the balance sheets are among the best I've seen in terms of overall debt levels, the duration of debt, the fact that the REITs have been curtailing their development exposure. They've got a lower dividend payout ratio, so in other words, are able to retain some cash flow to refurbish the properties, attract tenants, etc., keep the properties competitive. So from a balance sheets perspective, the REITs are in great shape. I mean, if you look back, the thing that gets real estate is two things: balance sheets, and that's not a major issue today. And the second issue is supply, building construction activity. And in the fundamental sense of in the fundamentals of real estate at the moment, it's great to see that supply is not out of kilter. Yes, it's increased as you would expect after a prolonged period of economic growth and low vacancy rates in commercial property. Supply has responded. I think it's a perfectly natural response. So overall, what we're seeing is moderate supply, strong balance sheets. We think the REITs are actually in very good shape, therefore. So in terms of the ability to provide effective diversification, that's why we think the REITs really do measure up. Now, of course, the other factor that we've got to take into account is pricing. It's clear that the REITs have had a relatively good 12 months, as I say, relative to equities, on the top of very strong performance over the last 6 or 7 years. So multiples on the cash flows of the sector are elevated. I'm not here to tell you that it's deep value, but I do believe relative to other asset classes, it is able to provide some diversification for the uncertainties that we're seeing. The reality is interest rates matter to everything. Right. Now, some people single out REITs and real estate as being particularly vulnerable. We're a little bit puzzled by that. The reality, as I said, is the things that matter most to real estate is the amount of debt and the amount of construction activity taking place. They're the things that will differentiate how REITs perform relative to other asset classes. The reality is that interest rates affect all assets. I mean, we don't think it's any coincidence that in the last 5 years, with QE, with low interest rates, that asset prices generally have moved up. Not just REITs, but if it's all about yield, as some people perceive REITs to be, and therefore vulnerable to rising interest rates, why is that we've seen things like classic cars and stamps and wine prices all at record highs? Now, there's no yield on those investments. So where does that fit into the yield discussion? The reality is, as I said at the outset, is that interest rates matter to all assets. What we've got to look for is the particular characteristics associated with each asset class to understand how vulnerable they are to rising interest rates. And what makes you vulnerable in real estate, again, going back to my earlier point, is two things: how much debt you've got and how much construction activity is taking place in the real estate industry. And on both fronts, we think that the sector is in balance. So as a consequence, we don't think the REITs are any more or less vulnerable to the impacts of rising interest rates.